For over a decade, Wall Street obsessed over every word coming out of the Federal Reserve, but the real collision point in global finance has shifted down the street, directly to the U.S. Treasury. Recently, Treasury Secretary nominee Scott Bessent detailed an aggressive new operation, doubling the size of the government's liquidity support buybacks for long-dated bonds. The mechanics behind this are straightforward. By injecting billions of dollars into the open market to purchase long-term bonds, the Treasury creates artificial demand. That demand pushes bond prices up, which mathematically forces their yields down. Algorithms treated the headline exactly as expected. The moment the program expanded, the 30-year yield immediately dropped 10 basis points. But within 24 hours, the market reversed course. The yield violently erased that initial drop and spiked to 5.31%. The last time it cost the U.S. government this much to borrow money for 30 years was the summer before the Great Financial Crisis. The bond market is actively rejecting the Treasury's direct intervention, exposing a flaw in the government's playbook. Between 2009 and 2021, tools like quantitative easing and yield curve manipulation worked with high efficiency. Central banks bought bonds and yields stayed predictably low. Those tools worked because the global economy was trapped in a deflationary regime. Core inflation rarely breached 2%. Suppressing the yield curve is effective, but only when investors holding those bonds have zero fear that inflation will eat away their fixed returns. We do not live in that environment today. The U.S. economy has experienced over 65 consecutive months where core inflation has remained above that 2% threshold. The Federal Reserve is actively struggling to manage this persistent price instability. Yet, simultaneously, the Treasury is attempting to suppress the very borrowing costs that act as the economy's natural braking system. Using deflation-era tools in an inflationary environment sends investors a clear signal. The government is prioritizing cheap debt over the stability of its currency. The Treasury is attempting to manage an inflationary era with tools designed for its opposite, leaving their strategy increasingly vulnerable to a market counterreaction. To understand exactly what the Treasury is trying to pull off, we have to look at a mathematical maneuver known as phantom deleveraging. It is a way to reduce the total face value of the national debt without actually running a budget surplus. This table breaks down the arbitrage. Let's look at the first step. The Treasury can issue $1,000 in face value of short-term 3-month T-bills, yielding roughly 3.88%. That raises about $990 in cash. Now look at the second row. Out in the open market, there are older 25-year Treasury bonds trading at heavy discounts, about 53 cents on the dollar, with yields around 5.25%. Here is the actual mechanical swap. The Treasury takes that $990 it just raised from the short-term bill and uses it to buy back those heavily discounted 25-year bonds. Because they are buying at 53 cents on the dollar, that same cash retires $1,836 in face value of long-term debt. This maneuver provides an immediate benefit to the government's balance sheet. For every $1,000 in new debt created, they wipe out over $1,800 in old debt. The overall face value of the national debt shrinks, and their annual interest liability drops along with it. While this is a sophisticated accounting maneuver, it comes with a severe structural cost. It significantly alters the duration risk of the entire U.S. debt portfolio. By swapping long-term obligations for short-term paper, the Treasury is actively manufacturing artificial buyers for long bonds, masking the true cost of government borrowing. Executing this buyback operation requires funding, which means the Treasury has to issue a disproportionate volume of short-term T-bills to raise the cash. This chart displays total U.S. marketable debt. The Treasury Borrowing Advisory Committee, or TBAC, has historically advised keeping T-bill issuance within a strict safety zone. You can see that recommended limit here, sitting right between 15 and 20% of total debt. But current operations have already blown past the historical 22.4% average. The Treasury is pushing this metric well outside the historical boundaries and into uncharted territory. Relying this heavily on short-term debt forces the government into an unpredictable cycle, making them roll over trillions of dollars every few weeks, regardless of what interest rates are doing at the time. The Treasury has exhausted its structural runway. They physically cannot issue enough T-bills to infinitely suppress yields on the long end of the curve. When structural limits are breached like this, a nation enters a state of fiscal dominance. This happens when the scale of government spending overrides all efforts by the central bank to cool down the economy. This chart tracks core PCE inflation over time. Notice the sustained plateau remaining elevated above the 2% target line for 65 straight months. The true engine driving this persistent inflation is the volume of federal spending itself. If we overlay government spending as a percentage of GDP, a clear correlation emerges. Federal spending is currently locking in at 23% of the entire U.S. economy. To put that 23% into context, the United States has historically only reached that level of expenditure during absolute national emergencies, like the 2008 financial crisis or the COVID-19 lockdowns. The bond market analyzes this data and understands the math. Deploying liquidity buybacks to manage yields against a 23% spending deficit is applying a Band-Aid to a gunshot wound. As long as the federal government consumes nearly a quarter of the American economy, mechanical yield curve tricks will completely fail to contain the actual cost of borrowing. Place yourself in the position of an institutional bond investor. You are locking your capital into a fixed nominal return. If prices rise, your purchasing power is crushed by inflation, debasing the real value of your investment every single year. This block diagram illustrates exactly how the market prices that risk. A long-term treasury yield is built on three foundational components: expected short rates, inflation expectations, and the term premium. The term premium is the risk compensation investors demand for holding long-term debt during economic uncertainty. Because the Treasury uses buyback mechanisms to monetize debt rather than cutting spending, bondholders act in self-defense. They are aggressively hiking the term premium. That spike to a 19-year high represents the bond market mathematically pricing in the mounting risk of fiscal irresponsibility. This brings us to a stark political reality. Neither side of the aisle is willing to implement the strict domestic spending cuts or the broad tax increases required to actually fix the fiscal deficit. Because politicians refuse to act voluntarily, fiscal discipline will inevitably have to be forced upon them from the outside. We saw an exact precedent for this in 2022, when UK Prime Minister Liz Truss proposed a massive, unfunded budget. Her bond market violently rejected the plan, cratering the currency and forcing her resignation in a matter of weeks. The U.S. Treasury's failed buyback operation is the early warning sign of a similar vigilante event building inside American markets. Control over the long end of the yield curve has shifted away from central banks and toward the bond vigilantes. Until the United States government aligns its fiscal reality with its monetary policy, the open market will continue to override the Treasury, weaponizing yields to force an end to the era of phantom deleveraging.